This is BDO in the Boardroom, a podcast by the BDO Center for Corporate Governance for the Board of Directors and those charged with governance. We're joined by your board peers and inspiring leaders to discuss the trending and timeless issues that are impacting today's boardroom agendas. Let's get started.
Hello and welcome to another episode of BDO in the Boardroom, where I am joined today once again by my colleague Todd Simmons, our National Managing Principal of Tax Risk Management and Tax Controversy and Procedure and Tax Policy and Legislation Technical Practice Leader. So a lot of titles, but this is going to be, I think, a great follow-up to our previous podcast, which took place pre-US election season. So we have Todd back to really give us his thoughts about, okay, we have the election over. What can we expect now with respect to income tax for corporate organizations in the US? So Todd, maybe give us a little bit of your crystal balling here, but hopefully we'll have a little more depth to the conversation now that we pretty much have a clear political party in power at this point.
Sure, Amy, and thanks for having me back. So I do think now that we've got a clear picture, and in this case, we've got a GOP sweep of the White House, the House, and the Senate, it does give a pretty good sense of where we are likely to go in tax policy. So when we last spoke, we were looking at a couple scenarios. And now that we have the GOP scenario, I actually think because of where we left off, and when I talk about that, I'm talking about the Tax Cuts and Jobs Act that was signed into law in 2017, because that was enacted under also a GOP White House, House and Senate, it's a little more foreseeable and predictable where we're going to be. The first order of business, I think, is to make sure, according to then candidate Trump's campaign promises, is to get much, if not all, of the I'm going to call it the Jobs Act or the TCJA, many of those provisions extended that were not already permanent. Now let's talk about some of those permanent provisions just to give a little bit of level set here. In particular, for corporations, the permanent provisions that don't expire after 2025 are going to be that 21% corporate rate. Now, of course, that was down from 35. So the 21% corporate rate stays. The new 15% corporate AMT, also referred to as CAMT, which was enacted in August of 22 in the Inflation Reduction Act, that is going to be permanent. Some increased Section 179 expensing is going to be permanent. The business interest limitation, limiting the deduction to 30% of adjusted taxable income, is. The NOL deductions being limited to 80% of taxable income. The requirement to capitalize and amortize research and experimentation expenditures over 5 years is going to become the law, or stay the law, I should say. And so these are the provisions that are already in the law. Now, some of these there may be interest in modifying them. We're providing some relief with them. We'll talk about that as well. In addition, the bonus depreciation phase out will have bonus depreciation gone by 2027. That amount will be zero. We know already there's interest in keeping that bonus depreciation alive, perhaps at 100%. The 20% qualified business income deduction under Section 199 Cap A, that goes away in 2026 without any additional legislative activity. And a host of individual provisions, including, of course, the top rate returning to 39.6 and the capital gains rate returning to that rate as well. Right now, under present law, the top capital gains rate is 20% and the top individual rate at 37. So without any legislative action, these provisions, many of them do go away after 2025. So the ones I just mentioned, again, starting with bonus depreciation, qualified business income deduction, the individual rates go away. So that's why, this has become an important piece of the Trump campaign, because the Jobs Act was a big part of his first term as president. Some additional provisions that go away in part are the international provisions that we have, the Global Intangible Low Tax Income, or GILTI provision. It's right now at 10.5%. After 2025, that rate goes to 13 1/8. Foreign derived intangible income, or FDII, that rate goes from 13 1/8 to 16% after 2025. And the base erosion anti-abuse tax, or BEAT, will increase as well. That rate is presently at 10%, and in 2026 is marked to go to 12.5. So the policy of those provisions sticks around, but the rates will go up. Finally, some estate gift and generation skipping transfer tax pieces here. The exemption amount was raised to 13.6 right now. That is slated to return to about 7 million after 2025. So there's a lot of things that really need to be addressed if the intent here is to maintain some of the provisions. And what I can do, Amy, if you'd like, I can go into some of the specific proposals that the Trump campaign had talked about over the past several months, if that works.
That would be great. Yeah, I think that would be very helpful to understand where we are heading beyond, just some of the, I guess, sunsetting provisions of the prior legislation. So please do.
Absolutely. And some of these will be familiar. Some of these are going to actually be some new policies. So when we talk about where we were on the Jobs Act, remember that now President-elect Trump would like to certainly extend many or most of those provisions and perhaps expand or bring in some additional policy. So we'll start with the corporate income tax rate, which I think is on the top of many executives' minds. Right now at 21%, again, it's permanent. Trump has indicated he would be interested in decreasing that rate a point to 20% now. And there'd be an additional decrease for companies that manufacture in the U.S. with an effective rate then instead of 15%. So we're going to watch that corporate income tax rate. The carried interest provisions, which came in the Jobs Act, treats as long-term capital gain, carried interest if it's held over 3 years. Otherwise, it would be ordinary income. The president-elect would extend that present law rule. Qualified Opportunity Zone investments, which encourage long-term investment in economically distressed areas. Under those provisions, certain deferred capital gains treatment is provided if the gains are from the sale of assets that are reinvested in a qualified opportunity within 6 months. Trump would extend that present law rule. Like-kind exchanges were limited under the Tax Cuts and Jobs Act to real property only, and the president-elect would extend that. Qualified business income deduction, I mentioned, that 20% deduction for certain qualified business income does expire after 2025. Trump would extend that deduction. What's not clear is whether it will be extended at its current 20% rate or that would be modified. The limitation on excess business losses for non-corporate taxpayers, which was added in the Jobs Act. Non-corporate taxpayers cannot deduct excess business losses for those married filing joint above $578,000. Trump would repeal that limitation, as was done in the CARES Act of 2020. Depreciation, as I mentioned, businesses may immediately deduct a certain percentage of the cost of eligible assets. That was phased out. And so what happened with bonus depreciation, it was 100% in 2022, 2021, a couple of earlier years, then went down to 80, 60, 40, and 20% in 2026, slated to be zero in 27. Trump would reinstate and make that permanent, that 100% amount. Some energy-related provisions came in the Inflation Reduction Act. There were some fossil fuel provisions like percentage depletion and expensing of intangible drilling costs. Trump would retain and keep those fossil fuel preferences. Some green energy provisions that came in as well include electricity production credit, clean fuel production credit, and an energy investment credit. Those were added in the IRA, the Inflation Reduction Act of 22. Trump has indicated interest in repealing these generally. I would imagine that perhaps the electric vehicle credit might stick around. So we'll have to wait and watch what happens there. In the Jobs Act, a 1.4% university endowment tax had become law. J.D. Vance had talked about increasing that excise tax to 35% on large university endowments. Now, what's not clear is whether that means large endowments of universities or endowments of large universities. So devil's in the details, so we still have to see if that's going to get any momentum. The 3 international provisions that I talked about, GILTI, FDII, and BEAT, there'd be interest in keeping those at their current levels, the lower rate, and not letting them increase in 2026 as they are slated to do under the present law right now. There's also some other global initiatives that we've been hearing about from the Organization of Economic Cooperation, or OECD, the so-called Pillar 1 and Pillar 2 provisions. So these are focused on ensuring that multinational enterprises pay their fair share of taxes according to the OECD. So there's 2 components to Pillar 1. There's Amount A and Amount B. That Amount A is the reallocation of taxing rates of the largest 100 multinationals to market jurisdictions, ensuring that they pay tax wherever they have significant customer bases, irrespective of their physical presence. That would require the U.S. to formally adopt via legislation. I think with a Republican sweep, there is less chance that we see this come to light in the U.S. as we would have in a Democratic sweep. Amount B is a fixed profit margin for distribution of goods. The IRS is issuing some guidance before the end of this year to implement the Amount B on safe harbor or on a voluntary basis. So right now, the Biden administration is working with the OECD on a mandatory version. Again, not certain whether that would continue after January. And Pillar 2 is the 15% global minimum tax on a country-by-country basis. This would require legislation, and again, seems to be little appetite in the GOP Congress for pursuing this. In fact, OEC had guidelines that would have wanted implementation about 2 years ago, and now I think it has been pushed out to 2025. Not sure we're going to see this. Interestingly, with the new corporate AMT, the CAMT, many thought that was really close to Pillar 2, the 15% minimum tax, but it's not what the OECD is looking for, and so it does not meet that requirement. Amy, I'll turn it back to you. Any questions or other issues to go over?
Yeah, if you could explain a little bit further in our decision whether or not to provide legislation around these OECD policies, what does that really mean for businesses that do have substantial operations and customer bases globally if we choose not to move forward with that?
Well, I think then right now we are still under a U.S. law, and there's some philosophical differences here. I think some would say, and I might be putting this a little too simply, is that the Democrats have taken a sort of, cooperate in the oral view about it being more likely that they would have warmed to pursuing these. And I think that the Republicans have looked at this as sort of anti-competitive from the U.S. perspective. So not pursuing these, I think, keeps things, under present law. Of course, in doing business in other countries, that's a different matter. So certainly our businesses will have to comply with the rules of other countries. But here in the U.S., we've got guilty, fitty, and beat. And, those are the rules that I think are just going to be in place going forward as it looks right now.
Thank you. Thank you for that. So I guess there's a lot of still to stay tuned and so forth, but do you anticipate that this will be top priority for the new administration in January to focus on taxes, or are there other areas that will maybe take precedent for the new president and Congress?
I do think this is going to be top of the pile. I've been hearing some rumblings, perhaps in Q1, but I think that's a little ambitious. In Q1, it's time for the staff to try to, get acclimated with what their roles are. We have a potential nominee for Treasury Secretary. We have to see the other Treasury positions that get appointed, like Deputy Assistant Secretary for Tax Policy, Tax Legislative Counsel. They'll help shape some of these provisions and help to get things moving forward. Of course, folks have to remember, Congress takes the lead on this. So it will really be up to Congress to determine when to go. But I do think there is ample support in the GOP side. And there, interestingly, is some support in the Democratic side for some of these provisions that expire that they may want to see extended to some degree. That's another reason why I do think we will start to see things happen sooner than later. With many of these things expiring after 25, I don't think they can wait too long.
True. So if I'm sitting on a board today and I am really trying to look at our strategic plan moving forward in 2025 and beyond, where would I be asking the management team, the tax department, for the most insight at this point?
Right now, I think what tax departments would be well advised to do is take a look at a world where many of these, if not most of these, Jobs Act provisions get extended for a period of time, and modeling how that works for the organization. What you're going to do in a world where taxes are not going to increase. I think they will either stay where they are, they go down perhaps a bit. So looking at that. And what is also important for tax departments to look at is whatever new legislation we see in 2025, what the effective date is of the provisions and what the expiration date is. In the current makeup of the Senate being under 60, members of the GOP, we're going to have 53 or 54 at the end of the day, unless the Republican Senate gets rid of the legislative filibuster. Under the current makeup of Congress, any tax legislation that they do pass is likely going to have another expiration date of 8, 9, or 10 years because of the rest of the budget reconciliation process. So that's something else that businesses need to think about in terms of anything that becomes law.
And then, as I think everyone is kind of looking forward to potentially some upswing in the M&A markets, Todd, is there anything specific in some of the pending potential tax changes that would either bolster that from a strategic perspective of firms in terms of timing of transactions, or are there other pitfalls that corporations should be mindful of when pursuing acquisitions?
Interestingly, Amy, one of the bills that the Senate had considered last year, which was a bipartisan bill to actually end corporate tax-free reorganizations for those corporations with assets, I think, of 500 million or more. Now, why I mention this is because it has bipartisan support. It was a bipartisan bill. It was in the Senate. The House has not considered it, but I mention it because it could be a potential revenue raiser, perhaps, as they take paper to pen next year. So we should probably watch that as well. I don't know if it's going to make it through the House. It really hasn't been tested too much, but we're already seeing corporate combinations on the table potentially in this next legislative round.
Todd, any other parting thoughts for our board member audience on what they should be focusing on?
Just watch and see what happens. Watch for the timing, watch for effective dates and for expiration dates. If things move smoothly and seamlessly, I think it would just be a matter of taking the provisions that corporations have right now, they're used to in present law, and extending them for a bit of time. So that's what I would watch. See if the Senate does remove the legislative filibuster. I can see a scenario where they are urged by the administration to do so. And if that's the case, then we may be looking at a permanent tax bill, which will change things back to the olden days.
Gotcha. All right. Well, I'm sure we will have you back as the new administration takes over in January and we see some of the things that you've discussed with us today come to fruition. So thank you for your time and, as always, your deep knowledge in the area of taxation.
Thanks, Amy. Thanks for having me back.
And thank you to all of our listeners, and please stay tuned for more from BDO in the Boardroom.
Thank you for listening to BDO in the Boardroom. If you like the show, be sure to rate, review, and subscribe wherever you get your podcasts. If you have any questions about what we discussed today, reach out to us via bdo.com, where you can also access the resources cited in this episode and learn more about the BDO Center for Corporate Governance. The views expressed by our guests do not necessarily reflect the views of BDO.